When people hear market risk, they usually think it means someone made a mistake. But market risk isn't about skill. You can have the same investor using the same math, putting in the same effort, and still get very different results. And the reason is simple: the market changes. And in real estate, the market doesn't just affect your outcome, it multiplies it. And that's what we're going to break down here. Real estate doesn't move in straight lines, it moves in cycles. And this chart you're looking at is the story repeating itself. It usually starts with a boom market, demand is strong, rents rise, construction accelerates, and then the market gets oversaturated. Too much supply shows up, vacancies begin to increase, rents stop growing, and then they start to fall. That's when the market slips into a recession phase. Financing tightens, values soften, and weak properties get exposed. Eventually, construction slows, supply clears, and demand catches up again. That's when the cycle turns and the next expansion begins. The important thing isn't predicting the cycle, it's knowing where you are in the cycle and when to buy. This building you're looking at is the first deal I ever bought. I had just taken a night school finance class at UCLA where I learned how to use the calculator, not guess, but read a deal. When I ran the numbers on this property, it jumped out immediately. And it's important to say this: it's the same calculator I'm giving you to use here, the follow along calculator linked in the description. To most people, this looked like just another building, but to me, it was clearly mispriced. And that's when I realized the calculator doesn't find deals, it just teaches you how to recognize them. Here's the basic spreadsheet I used at my night school finance class. Over time, it got rebuilt and upgraded into Excel. Same assumptions, same math, just easier to use. This is a calculator built as a spreadsheet you can download and now follow along with. When you find a deal like this in the right market, everything gets easier. Gross rent multipliers stay supportive, prices make sense relative to the rents, and opportunities show up faster. Financing is available, properties move quickly, you don't feel like you're forcing anything. And that's what momentum feels like. And if you're not careful, it starts to feel normal. Like this is just how real estate really works. This is what momentum actually makes possible. In a supportive market, you're not just buying and holding, you're able to move. We bought properties, let the market do its work, and then exchanged up. A smaller building could be turned into a larger one. A larger building could be refinanced, exchanged, or sold at a profit. That wasn't aggressive strategy. That was momentum combining with time. When markets cooperate, good decisions compound. This is where investors get fooled. When the market is strong, success starts to feel earned, like you figured something out. Rents are rising, values are climbing, construction is everywhere. But quietly, something else is happening. Deals start to disappear, prices rise faster than rents, multipliers expand, competition increases, and eventually, the same deals that worked before just don't work anymore. Not because you forgot how to do the math, but because the market has moved. When I bought in Wilmington, vacancies were high and the market had just come off a recession. Nothing new was being built, supply was tight, jobs mattered. Later, I took almost the same multipliers and cap rates and laid them over Fresno. On paper, it looked right. Growing population, new construction, momentum. What I missed wasn't the math. It was where the market was actually moving. Markets don't just move forward, they move around you. This is the part most spreadsheets don't show. Market risk is more than math. In this case, the local market was already weakening. Tenant stability broke down, and the rents never actually stabilized. On paper, the numbers still look close enough, but on the ground, the market was sliding. Vacancies rising, rents falling, and once that happens, the assumptions underneath the deal start to fail. And when assumptions fail, the next problems show up fast. Refinancing becomes impossible, not because the calculator was wrong, but because the market underneath it changed. This is where real risk shows itself. It attacks your assumptions. First, refinancing disappears. The numbers don't support it anymore. And then you realize you can't sell either, not for what you paid. If interest rates move up at the same time, values come down even more. Meanwhile, rents fall, vacancies increase, and expenses keep rising. At that point, you're not managing a property, you're in a squeeze. And once you're there, the exits you thought you had just aren't available anymore. This is how it ultimately played out in Fresno. We had three buildings. One was foreclosed, one was taken over by the lender, and one was sold but at a loss of our equity. In different ways, the outcome was the same. The equity was erased, and at the end of the day, the entire partnership lost money. It's not a story about bad intentions or lack of effort. That's what market risk looks like when it fully runs its course. What's important to understand is that these things happened at the same time. Some properties benefited from momentum. They could be exchanged or sold up successfully. Others were exposed by local market conditions and moved in the opposite direction. The difference wasn't the effort or the intent, it was location and timing, and where each property sat in the cycle. And that's what market risk really does. It creates very different outcomes, but all at once. One thing you learn pretty quickly is this: all real estate is local. Before you ever commit to a deal, you've got to see the neighborhood. Drive it in the morning, drive it during the day, drive it at night. Pay attention to what's really going on. Are people coming and going? Are cars moving or are they just parked? Then check the real rents, look for for rent signs and call on them, and see what's actually getting rented, not just what's online. And as a rule of thumb, buy as close to home as you can, ideally within about an hour. If you can't get there easily, you can't really know what's going on. The walkthrough comes later. This part is about knowing the area you're buying into. This is how experienced investors think about market risk when they structure a deal. First, they lock in long term fixed rate debt. They don't want their financing changing when the market does. They underwrite conservatively, not best case assumptions, but survivable ones. They make sure the margins are wide enough so small problems don't become big ones. And when interest rates are low, they refinance and reset the deal. Not to get fancy, but again to reduce risk. And most importantly, they give themselves time. Time is what lets good markets work and bad markets pass. Market risk can't be avoided, it can only be understood. And optimism doesn't protect you, structure does. Prediction isn't the goal, understanding is. And that's why this playbook exists, to make risk visible before it becomes expensive.